Okay, thanks all for joining. This is the 7th Liquid Staking Working Group call, so welcome. Today we have two really great presentations. The first presentation will be Regina Cai from UMA, and she's going to do a presentation on priceless synthetics. So that should be really interesting. So far we mentioned synthetics in the liquid staking research document we're writing, and we wanted to invite Regina along to kind of give us an overview of what UMA are working on, so we can have a deeper insight into how synths work and you know how they could be applied in this liquid staking space. And then the second presentation will be Jonas Lamis from StakerDAO and Tezos Capital. So StakerDAO are building this DAO on Tezos platform. The first product is called Blend, and Blend allows you to invest in proof of stake tokens. So it's a diversified fund across multiple proof of stake tokens, so you can get exposure to basically a basket of proof of stake tokens. So that should be really interesting as well. So I guess I'll kick off, or we'll get Regina to kick off first. Regina, are you there?
Yeah, hi. Thank you for having me.
That's great. Thanks a million. Do you want to share your screen of your presentation?
Yeah, that'd be great.
Okay, yeah, go ahead. You should be able to share.
Great. 1 second. Okay. So everyone can see this?
Yes.
Okay, great. So hi everyone, I'm Regina. I am a part of the team at UMA. We're building infrastructure for decentralized financial contracts on Ethereum. And what I do is a combination of financial engineering, a little bit of like content writing, a little bit of giving talks like this at different events, and just trying to generally educate people on what the infrastructure is and what kinds of financial contracts you can build with it. One of the components of that infrastructure layer is these types of financial contract templates that we think have hopefully economic incentives and mechanisms that make them all work. And I'm going to use work in this very sort of general sense to describe financial products that have a variety of desired properties, like trading at the right price, having the right types of arbitrage incentives, settling to the right amounts. And so I'm going to describe today a financial contract template that we've designed that doesn't use an on-chain price feed. And this is complementary to the second part of our infrastructure, which is an Oracle service. And at UMA, we really think about oracles as a sort of dispute resolver of last resort. So we don't see oracles as necessarily on-chain price feeds. We see them really as more services that can be called on relatively infrequently to resolve certain disputes that people might have. Now, the disputes that we imagine the oracle resolving relate typically to the amount of collateral that's backing these types of decentralized financial contracts. So that's kind of how we envision all of that infrastructure coming together. And I'll also say, if you have any questions, feel free to jump in. I'm open to questions in the middle of this talk. I clearly don't have, very ordered slides, but I wanted to highlight a couple of topics that are relevant to, I think, synthetic tokens generally, and then also how we approach them and how we're trying to make synthetic tokens without on-chain price feeds. So feel free to hop in if anything doesn't make sense along the way. Great, so I'll begin by talking about what synthetic tokens are. Was there a question? Or?
So it is plus 100.
I'm just going to mute some people here, so
work
away.
Okay, cool. So I'll start out by talking about...
What's an issue? You increase depreciation.
Okay, so I'm going to get started by talking a little bit about what synthetic tokens are. And these are not a new concept in the sense that we have written about these in the past, starting in September, October of last year. And in fact, we think of synthetic tokens as a general class of financial products on the blockchain, of which stable coins like DAI or other synthetic backed tokens are all kind of a subset. So what I mean by that is in this diagram, most synthetic tokens are things, these little gold coin things that I've drawn, right? Synthetic tokens are tokens that are minted from a, whether you want to call it a CDP, a vault, a token sponsored position, that are backed by effectively a certain amount of backing collateral, an amount of additional required excess collateral, and then any additional collateral that might be on top of what's required. So if I'm to analogize this to a maker CDP, this is the amount of ETH that is required to back just the amount of DAI that you've borrowed. You have some amount of additional collateral, that's at 50%, right, the 150%. And then you might top off your position with an extra, say, 20%. So you might bring your total amount of ETH collateral to be 170% of the amount of DAI that you've borrowed, right? So this is what I mean by a synthetic token. It's a token here, whether it's DAI or some other token, that's backed by collateral that's in excess of this backing collateral, okay? And so typically, what people have designed in the past and what we initially designed was something where the amount of required collateral and the amount of backing collateral is provided on-chain by an on-chain price feed. So if you have an on-chain price feed that's regularly pumping in prices, say every 5 minutes, you know at all times whether or not the amount of backing collateral and required collateral is met by the total collateral, right? So what happens is that on-chain price feed changes this number and it changes this number, and you see if this number is above or below this number, this required collateral, right? And once you're below the required collateral, there's some liquidation process, some auction process to bring you back above this amount. So, right, that's the second diagram I have here. So if these amounts move and, you know, all of a sudden you have total collateral that's below your required collateral, great, you have some penalty, and we try to bring you back above that level. So this should all be quite familiar to anyone who has seen how maker CDPs work or vaults work. Nothing surprising here, right? Okay.
Yeah, makes sense.
Cool. So the fundamental problem here, though, is that we require an on-chain price feed to tell us what these numbers are. And that's a really big problem because, as we can see with other protocols that rely on oracles to trigger transactions, like the kind of auction or liquidation process that you might need, if that number can be spoofed or manipulated or otherwise impacted, you can affect a lot of transactions on-chain that might have knock-on effects that you don't want. So how do we solve this problem, right? I want to make sure that this position still remains properly collateralized without having to pump in an on-chain price feed, which not only having, you know, the problems I just mentioned, is also expensive and difficult to maintain, generally speaking. And so our solution is what we're calling Priceless synthetic tokens. So this is something we put out a week or two ago, and this is, as it says, a new DeFi design to minimize Oracle usage. So we want to still create the types of synthetic tokens we're talking about before, but get rid of that on-chain price feed. And so I'm going to, I mean, you can read this on your own. I'll send the link around as well. But I'm going to use more of our documentation site to explain how it works, because I think this has some diagrams and has some more writing that you guys might be able to follow along better as we go through. And so I'm going to walk you through the life cycle of a synthetic token so that you can understand what the different mechanisms are that keep the token properly collateralized even without an on-chain price feed. And it's a little bit of a It has some inspiration from, you'll see if you've been following what Optimism or Plasma is doing, or if you're following state channels and you're thinking about other layer 2 solutions, you'll see some of those concepts mirrored in some of the diagrams and mechanisms that we've designed. So just keep that in the back of your mind if that comes up and if you have any questions about that. So to start, let me walk through how you create these synthetic tokens, right? So it looks a lot like the diagram I had before. You put a bunch of collateral into the smart contract and it gives you a synthetic token that you borrowed, right? So we call those people token sponsors. Now, what's happened in this diagram, right, is someone has deposited collateral and the smart contract doesn't know whether or not the amount of collateral that you've deposited is sufficient to back the synthetic token, right? So what it says is, okay, well, if you're the first person to do this, right? If you're the first person deploying the smart contract and creating these synthetic tokens, go ahead, do whatever you want, right? We don't know. We're really relying on the ability of other people to discern whether or not you've deposited enough collateral in buying your synthetic tokens to really tell you whether or not you've done this correctly. The idea being that if you're a token sponsor and you have some ill intentions and you don't deposit enough collateral, but you mint these synthetic tokens and you try to sell these to people, those people should not be willing to buy it because they should be able to look under the hood and see that you haven't deposited enough collateral. So that's kind of the idea, and that is the, I think, fundamental principle guiding a lot of the mechanisms here, is that people will be able to infer information about your positioning and about your collateralization without having an on-chain price feed. So in this example, right, if you're the first person to do this, the idea is, well, you should deposit enough collateral such that when you create these synthetic tokens, you can credibly sell them to people in the market. But then if you're someone who comes in after that, right, if you're the second token sponsor, the smart contract is going to require you to collateralize your position to at least as much as what we call the global collateralization ratio. This global collateralization ratio is effectively the average collateralization ratio across all the different token sponsors in the ecosystem who are all interacting with that smart contract. Does that make sense?
Yes.
Awesome. Cool. So that's how you would initially create these synthetic tokens, right? But now we have questions of, well, how do you, as a token sponsor, do all the things that you were typically able to do with the Maker CDP, right? How do you manage your position? How do you liquidate other people? How do you redeem your tokens and so on? So walking through some of those steps, right? Now let's say I'm a token sponsor, right? So let's say I've put in some amount of collateral and I've withdrawn these synthetic tokens. And let's say that the price feed for this is the price of 1 ounce of gold. Okay, so let's say, for example, that that's $100. And so I've deposited, say, $150 worth of collateral, and I'm borrowing $100 worth of synthetic tokens, which represents 1 ounce of gold, a synthetic gold token. Now, I, as a token sponsor, have that synthetic gold token, right? What am I going to do with it? I'm going to sell that token to someone else to get short exposure to the price of gold. And that's a little bit complicated to think about. So I'll say it one more time because sometimes it can be a bit confusing. My position as a token sponsor is, let's say initially I have $150 of something. Let's call it ETH. I want to get short gold exposure. So what I'm going to do is I'm going to put that $150 worth of ETH into a smart contract and then borrow a synthetic token, a synthetic gold token that's worth $100 of that collateral. I'm going to then sell that synthetic gold token to someone else who will then buy it and have long gold exposure, giving me short gold exposure. So notably, during this process, the token sponsor, I actually end up with no risk to the price of gold. My exposure to the price of gold only begins once I sell that synthetic token to someone else. Okay, so let's say I've done that. And now I see that I need to manage my position, right? Let's say the price of gold in the real world, I can see, has gone up. Well, what I'm going to do is I'm going to want to deposit additional collateral to top up my position, right? So this means, you can think about this in two ways. One is that as the token sponsor, as someone who wants to make sure that I don't get liquidated, right? I need to add additional collateral to the position to ensure that there's enough there to back the tokens that I've minted. And the other way to think about it is, remember, I'm someone who's short gold. So just like if I were trading on an exchange and I were short gold, I'd have to top up margin in that position. It's the same idea here. I'm topping up margin to keep my position open, right? So that concept should be pretty straightforward. But now let's say that the price of gold has dropped has dropped. And I want to withdraw some of the collateral that I've deposited into the smart contract. Here we need to be a little bit careful because, again, remember the smart contract doesn't rely on an on-chain price feed to tell it how much collateral you need to have in the position. So that means that it also doesn't know how much margin you can safely withdraw from the position without being under collateralized. So what we do here is we have what's called a fast withdrawal and a slow withdrawal. In a fast withdrawal, if I'm a token sponsor, I have a two-part process to withdraw collateral. The first is to make a request to withdraw the collateral and wait for what we call the withdrawal liveness period to elapse. Now, what this does is it gives, let's say, 1 hour for anyone else in the system to look at my position and say, actually, if that token sponsor withdraws the total amount that they've requested, they will be under collateralized, right? So what happens is people can see that, oh, well, that means that I should liquidate them. And what we're doing here is we're saying we're relying on other people to liquidate token sponsors based on their withdrawal requests without requiring an on-chain price feed. So instead of an on-chain price feed pumping a number to the smart contract indicating that, okay, it's okay for people to liquidate, you always allow people to create those liquidation requests. You know, we have a way to resolve people creating too many liquidation requests later, but that's the fundamental idea, remember. It's, again, not using on-chain price feeds to tell smart contracts to automatically process certain transactions, but relying on outside actors to observe what is happening, to observe that withdrawal request, and then to act upon that if they feel like it would result in under collateralization. So that's here you can see basically this is the slow withdrawal, right? And that we're taking some time. We're using this liveness period to allow people to dispute something. A fast withdrawal would be the same thing, but here, the token sponsor, if at the end of withdrawing this collateral, they're still above the average collateralization ratio, we allow them to withdraw that collateral immediately. And the reason for that is that, again, if you're withdrawing collateral that leaves you over collateralized and meeting the global collateralization ratio, meaning you're at least as collateralized as the average token sponsor, the idea is that, well, if no one else has disputed the token sponsors with collateralization that's less than you must be properly collateralized as well. So here we have, again, this concept that we're relying on other people to observe whether or not other token sponsors are properly collateralized, and using that to infer whether or not you as a token sponsor are properly collateralized. So I'll pause here because I think this is one of the fundamental mechanisms that we have, just to make sure this makes sense and if people have questions.
I have a question on the global ratio.
Mm-hmm.
And it may be easier for me to just get in here and read it because I see there's a link to it. So just let me know if it's too distracting in the conversation.
Mm-hmm.
But ultimately, how is that set? What is the path to? Is there a benchmark of total positions, total liquidity, total thresholds that derive us at a global ratio? And how do you get to a global ratio when the system is, I guess, started by individuals?
Yeah, that's a great question. So the global collateralization ratio is a simple calculation of the average collateralization of all the token sponsors interacting with a single smart contract, because a synthetic token is defined by the smart contract that it's minted from. So what happens is, you're right at the beginning, the GCR, as we call it, is just equal to the collateralization of the single token sponsor interacting with the smart contract. But as more token sponsors come in and open up positions, we calculate the GCR as the simple average across all of their positions. We do exclude anyone who has an outstanding withdrawal request, anyone who's currently being disputed, right? So anyone who we think might not be properly collateralized because someone has come in to liquidate them or dispute them. But we take the average across all the other token sponsors to indicate that that's the average collateralization ratio for like all the token sponsors who we consider, or who all the token holders who have not liquidated someone consider to be properly collateralized. Does that make sense?
Yeah, and I guess what I was poking at, thank you for that, is at the very beginning, like, you know, will there be a required percentage?
Oh, I see. Mm-hmm. Yeah, so I think the answer to that, I would say, is no. Although that's my own opinion, and anyone is free to, I will emphasize, you know, anyone's free to take this template and add features or experiment with it as they see fit. But I think that the reason the answer is no goes back to one of the things I was talking about before at the very beginning of this presentation, which was that we're relying a lot on token holders to also do some due diligence as they look at these synthetic tokens that they're looking to buy, or whoever's distributing these tokens to other token holders. And so the idea is, at the very beginning, I agree that the GCR is a single number influenced by a single token sponsor. And so we're relying really on the distribution of those tokens, or the people who want to buy those tokens, to really look in and see if the GCR makes sense, right? So I think you're right that is an area of concern, but that's kind of part of the overall principle behind allowing other people to indicate, right, and provide those signals to the smart contract themselves.
Cool, thank you, great answer.
Great.
I also think that there. Sorry.
I have a question. So, like the way I'm imagining this is, so there's like a gold token, and let's say the average collateralization ratio is I don't know, 2 Ether per gold token. So that's the average of everybody that's in there.
Mm-hmm.
Now, and maybe let's imagine the total amount of Ether that are committed to this contract is 10,000 Ether. So it's 10,000 Ether, 2 Ether per gold token, 5,000 outstanding gold tokens, right?
Okay.
Replace gold with whatever to make numbers make approximate sense. Now, assume I'm Ether rich. I have 100,000 Ether sitting with me. I can pour those 100,000 Ether into the contract and jack up the average collateralization ratio at will. So if there are 10,000 Ether already in there, 5,000 outstanding gold tokens, if I put in 100,000 Ether myself and mint no new gold tokens, the average collateralization ratio is going to go from 2 to 21. I can jack it up, and I can then withdraw my things, and I can jack it down also. And so when I jack up the average collateralization ratio, people that were over collateralized are now under collateralized, right? So
okay.
I can do a combined attack where there's a single transaction which jacks up the collateralization ratio and liquidates other people, and I make a profit.
Okay, great. So yeah, I should clarify that, we haven't even talked about the liquidation and dispute process. And I think one thing I'll emphasize here, which I'll go into a little bit more detail in just a moment, is that any liquidation, right? So here we're saying that the withdrawal liveness period has to elapse without liquidation. Any liquidation is an indication that a token sponsor is improperly collateralized, not to the GCR, but to the other parameters of the contract that indicate how much collateral should be in there. The GCR should always be, but it should always be above the required collateralization ratio, right? But all disputes about liquidations and those actions are always reflecting the required collateralization ratio. So I'll go into the liquidation and disputes to help clarify that, unless anyone else has any questions beforehand.
Actually, I have one. there was another part of Colin's question that was related to the liquidity of the collateral. In the GCR, are you taking into account the liquidity of the collateral, its nature, etc., etc.? Because it's pretty easy also to try to manipulate the price of the collateral in order to make it seem like the position is over collateralized where it's not.
So I think the answer to that is there are two answers. One is that anytime someone deploys one of these contracts, they need to register it with the DVM, which is what we call the Oracle, the data verification mechanism. And in that registration process, they'll have to indicate the parameters that they want to use in the deployment. So they'll have to register, here's the price identifier I want to use, here's the collateral I want to use, here's the collateralization ratio I want to use, the required collateralization ratio. And so there is a governance process around financial contracts that use the UMA Oracle. And so there is a layer of governance there that I haven't gone into, but we can talk about later. The second answer to that, I would say, is that if you think about the liquidity of the collateral that's being used and you say, oh, well, someone could, if you're a whale, you can go in and in an illiquid market, pump up the value of your collateral or decrease the value of the collateral. That is very true. But the idea is that in the liquidations and disputes that we have, there's a lot of human judgment that's being used, this decentralized human judgment that's really assessing whether or not markets have been manipulated. And I think this is a great segue into the liquidation and dispute process because it emphasizes that instead of having transactions like liquidations or debt auctions or those types of things be triggered automatically by on-chain price feeds, we're really using other people and inferring information from their actions about whether or not there's sufficient collateral. So with that, I'm going to head into the liquidation and dispute process. And I think this is also sort of very key to the performance of any of these contracts. So remember in the previous example, I had said, someone wants to make a withdrawal request and other people feel like if they withdrew that amount of collateral, that position would be under collateralized. Again, not to the GCR, but to the required collateralization ratio. What someone might do is submit their tokens, their synthetic tokens, to the smart contract to liquidate that token sponsor. So let's say I see that there's a token sponsor out there who has 10 tokens and I feel that they don't have enough collateral to back the 10 tokens at a required collateralization ratio of say 120%, right? I might go in and submit 10 tokens to the smart contract to liquidate that token sponsor, okay? So this is kind of the first stage, this section is the first stage of any liquidation. Now, from this liquidation, there are a couple of different paths that this process can take. Right, so I'm going to flip to this diagram now, but here we started with a liquidation. Now we see if the liquidation is disputed within the liveness period, right? So any liquidation has an associated liveness period. And during that time, if no one disputes the liquidation, it just gets processed. So if after 1 hour passes, someone just goes in, touches the contract again and says, okay, process the liquidation. And in that liquidation, what happens is, let me go back to this. All the collateral deposited by the token sponsor gets sent to the liquidator, right? So it's like, we just agree, okay, your position was improperly collateralized. The liquidator is going to receive all of your collateral and you have no need for an Oracle call, okay? So I'm gonna walk through all of these stages first and then go through questions, but that's sort of the first path that we can go down, right? If you follow this, great. Now, someone can come in though and say, well, actually, I think that liquidation is incorrect. I think the token sponsor was properly collateralized. So I'm going to come in and dispute you. I'm going to dispute your liquidation. So what does that mean? Well, now it gets a little bit more complicated. But a disputer, right, does what I just said. They post a dispute bond to the smart contract to dispute this liquidator. This liquidator has already deposited synthetic tokens to liquidate the token sponsor. So now everyone has skin in the game. The disputer, the liquidator, and the token sponsor all have skin in the game. and we need someone to resolve the dispute here. This is where the DVM comes in. The DVM is requested for a price and from the smart contract. The DVM is controlled, or not controlled, the DVM responds to the price request by asking all holders of the UMA voting token to vote on what they think the correct price is. I won't go into the details of how it's calculated, or determined, but the idea is that the smart contract then it knows what the price is, and it's able to figure out what allocation of collateral should go to the liquidator, to the disputer, and to the token sponsor. So that's what happens here, right? The DVM determines the outcome of the dispute, and it determines whether or not collateral should be sent, or how much collateral should be sent to the liquidator, the disputer, and the token sponsor. So I've given some colors here to indicate who can be correct, right? Either the liquidator is incorrect or the liquidator is correct, and so the disputer is correct or incorrect. But this is another big part of the design of a priceless synthetic token, in that you have this decision tree where periodically you have different layers that can allow you to avoid having to use the oracle, like at this layer. And then you also have this kind of last resort service of the DVM to help resolve any disputes. So that's the gist of how it works. Here in these diagrams, I have more details on how collateral might get returned to the liquidator or the disputer or the token sponsor, right? Which we can go into more detail if that's what people prefer. But I also want to pause here to go over any questions about just the fundamental idea behind, I think, this decision tree, and if this makes sense to people. Is there anything in the chat? Okay, great. Yeah, and so if no one has any questions about this particular tree, I'm going to move on and describe some of the more details about how collateral gets sent back to the liquidator, disputer, and token sponsor. So remember here, right? I said the DVM has already been called here, and so we know the exact amount of collateral that's required to back the synthetic tokens. Now that we have that information on chain, we can actually do the proper allocation of collateral. So if, right here I say, if the DVM indicates that the token sponsor was under collateralized, that means that the liquidator was correct in liquidating the token sponsor, and the disputer was incorrect. So what should happen? In this case, we say the dispute bond is forfeited, the disputer gets nothing back, and the liquidator receives, again, all the collateral that the token sponsor received, so just as would normally happen if there had not been a dispute. But in addition, they also receive the dispute bond, right? So what happens now is it's quite clean, and it mirrors a lot of what we saw before. So that's that branch of the tree, right? This is where the liquidator is correct and the disputer is incorrect. Okay, now what? Well, if we're in the other branch, right, and it turns out the token sponsor was properly collateralized, what should happen, right? Well, the disputer was correct. So they should receive back the bond that they posted, as well as an additional reward. Okay, well, who pays the reward? And here we have a question of, well, how much collateral should the token sponsor receive? Well, the token sponsor should receive any collateral they had in excess of what was just required to back the synthetic token, right? The remaining collateral, as well as a reward for how they were improperly liquidated, right? So they should also receive a reward. So that means that these rewards that are paid to the disputer and to the token sponsor should be paid from the liquidator. So what I have here is the liquidator should receive the token redemption value, which is just the amount of back-end collateral for the synthetic tokens, which in my example, right, would be just the amount of collateral that we needed to match the price of 10 ounces of gold. That amount, less these rewards that are paid to the disputer and to the token sponsor for that improper liquidation. So now with this all together, right, this should provide a complete picture of what the mechanisms are and what the incentives are for people to come in and liquidate or dispute certain positions. And we hope that this provides a useful template for people who are thinking about creating synthetic tokens and trying to figure out ways to minimize Oracle usage. I think that's one of the biggest features of this design, is that we've really tried at each step to minimize the usage of an Oracle. Arguably, we could have stopped right at liquidation and said, well, after someone liquidates a position, we'll immediately place a request to the Oracle, right? And once we have that information from the Oracle, well, then it makes it easy. You know exactly how much collateral corresponds to the token redemption value. You know exactly how much collateral should be paid to everyone. But what we've done is we've also tried to make an additional layer here where you don't need the Oracle, right? By adding this dispute period. And so you can see some of the inspiration of, I think in state channels are called exit games, right? You can see a little bit of that inspiration here. So that's the overview of how this works. There is a last section on how you redeem tokens and how you redeem things before or after expiry. I'll just note this is pretty straightforward. If you redeem after expiry, we just have a requirement that at expiration, the DVM will return the final amount, and then collateral gets divided up between token sponsors and token holders appropriately. But this is fairly straightforward. It's just like a dispute, but if there were no bonds and no rewards or penalties paid to anyone. So I'll pause here and see if we have any questions about this. I would also encourage everyone, if you have any questions, please feel free to tweet at us, join our Slack, ask questions, propose ideas for your own tokens that you think could be useful. I know that when I spoke with Brendan, this initially was about maybe synthetic tokens. I wasn't sure if it was synthetic tokens as collateral for other types of products, or if you were thinking about synthetic tokens as a way to create staking derivatives. But I think hopefully this provides a useful framework and a useful tool in your mental models around synthetic tokens.
Yeah, it's Brendan here. I think we're kind of looking at both, right? I mean, I think the whole goal of this liquid staking is to create, to make staked assets liquid so they can be used as collateral. So that's the first step, and it feeds into this process. But we're also looking at, like, maybe we don't need to do liquid staking at all. Maybe some kind of synthetic representation of a stake is a better way to do this, right? Because liquid staking comes with its own complexities about unbonding periods and flashing, and there's a kind of lack of fungibility with validators. So maybe it's better to try, and if you want to capture the rewards of proof of stake networks, maybe it's better to try and do it as a synthetic rather than trying to make it an actual derivative of a staked position.
That makes sense. And I think here what's really useful is that, again, even though I suppose with a lot of proof of stake networks, the staking rewards are on chain, and so you can easily observe them and make them an on-chain price feed if you wish. One of the cool things about this is that potentially, and I'm just thinking out loud here, you could incorporate things like the spread between the staking rewards of on-chain assets and other real-world interest rates that are otherwise not observable on-chain. Or you could incorporate some kind of product on that spread. Just an idea.
Yeah, that's pretty cool. The Oracle that's working here. So you're saying that the token holders vote on the correct price. Can you? It's probably out of scope for your presentation, but can you give us a kind of just a quick overview of how that might work?
Yeah, for sure. And yes, I agree with that. It's a little bit out of scope of what I had intended to talk about, but happy to discuss. The UMA DVM is, again, this Oracle that responds to price requests that we hope will be very infrequent. But when they do come up, the idea is that a price request is enqueued with the Oracle, and all holders of the UMA voting token are open now to submit their vote on what they think the correct price should be to be returned to that financial contract that submitted the price request. This happens in a two-part commit reveal voting period. In the commit period, you commit your vote, and then whether it's 24 hours later or however much later, in the reveal period, you reveal your vote. And then what happens is, I believe right now, the Oracle takes the mode, I'm going to say, the mode of all the votes that come in. And it returns that mode as the determined price to be returned to the financial contract. So in that way, it's very much like a Schelling point based system. But that's kind of the overall idea, is that you're allowing people and you're giving people time actually to look at the information that exists off-chain to really process that and return what they think is the correct price to be returned to the contract. So I think someone else had tweeted about this earlier, is that not only here are we hopefully increasing the security of these financial contracts by reducing reliance on an oracle, but we're also allowing people to actually have time and look back in time and do a little bit of a post-mortem on types of data that are being requested by the financial contracts, so that we don't end up with very, very large movements on-chain.
Okay. And that's the price at a specific point in time, because I'm guessing, like you're saying, it could be a couple of days. So it's a dispute about the price potentially 2 days ago at a very specific point in time. And what's the kind of granularity of that then? Is it down to kind of at a particular second or?
Yeah, so I mean, in the code, it's I think just down to the exact timestamp of what you're looking for. And so right now, I'd say that's kind of the level of granularity, but I will emphasize again that there is some level of governance around the financial contracts that are registered with the DVM. And so anyone who holds the UMA voting token can also opine on in that process whether or not the financial contract that's proposing a bunch of these parameters is making a reasonable request or should be included in the set of financial contracts that UMA voters should vote on. So for example, if there is a request to add a financial contract that has a very esoteric price feed that wants such granularity, UMA voters might have a discussion about that before voting to approve that financial contract template.
So
great.
One question is, are you imagining these UMA voters as sort of actual humans that are going back, looking at the data and putting stuff in, or just machines that are programmed to just look at some data stream and put it in? What do you want them to be, humans or machines?
That's a great question. I think a very existential one for the Oracle. And I think right now, as we've designed it, hopefully there are a very limited number of price requests that are made to the Oracle, meaning that in the early stages of the Oracle, probably we'll have humans looking at numbers and responding to those price requests. But who knows what'll happen down the line, whether or not, these price requests actually end up being more frequent than we imagine. Maybe there are a lot of different synthetic tokens out there. Maybe there's a huge diversity of different numbers that humans aren't particularly specialized to read, but robots are. I think, so I can answer kind of at the very beginning, I think it'll be humans, but I think down the road, we're very open to seeing what kinds of voters people end up being, or what kinds of personas, liquidators, or disputers end up being.
Maybe I missed this, but I had one question. What is the incentive for these voters? Do you have to be like within some range of this mode of the price in the end, or?
Yes, exactly. So, right. So there is inflation of the UMA voting token. And if you vote correctly, then you receive those rewards. And if you do not vote correctly, then you do not receive those rewards. Yes. Great. I see that there's a question in the chat about incentives for token sponsors. And to clarify, again, for these token sponsors, we really think of them as people who are trying to get short exposure to the price index of these synthetic tokens. So I don't think of particularly needing to incentivize token sponsors to do this, in the sense that in any market where someone wants to get long or short a type of financial risk exposure, so long as those two counterparties can find each other and agree on a common price, you don't necessarily need to incentivize them to participate. Now, again, there are other constraints here. So for example, you might say, well, it looks pretty capital inefficient. It looks like someone who needs to be a token sponsor or wants to be a token sponsor needs to put up a lot of collateral to do this. And that's certainly a consideration. Hopefully, those kinds of capital constraints can be addressed by some new innovations in flash loans or things like that, or batching transactions together. But I think generally speaking, from a financial engineering perspective, I don't think you necessarily need to incentivize the token sponsors, but from a technical perspective or from a capital constraint perspective, I think there are definitely promising tools from a technical perspective that can help with that. Great. Are there any other questions?
I guess that's it. That was fantastic, Regina. Thanks a million. Thank you very much.
No problem.
Thanks, everyone. That was really interesting. And I think it is very useful for us just to kind of get an understanding of how these things are working and how they're evolving. So that's great. Thank you very much for that.
No problem. Thank you for having me.
Okay, great.
Okay, thanks.
Okay, yeah, no worries. I think Jonas might be running a little late. So Christian, are you going to kick things off with the StakerDAO side?
Hey, Brendan. Yeah, I'm just going to give a quick overview of the Staker side, and I think Jonas is going to hop in here, and then we can walk through the blend overview of things.
Okay, great.
And
yes, do you want to take over then? Do you want to share your screen?
Yes, I'll share my screen. Thank you. Great. Can you see my screen?
Yep.
Yeah.
Okay. And so I do have some fancy decks for you. And I'm just going to start off with a quick overview of StakerDAO. I'll preface this by saying it's a bit more of a centralized solution. Here to start with more of a target for the institutional side on the family offices, more so than the retail. And so I think that's just the thought we'd like to enter this with. And so kicking off StakerDAO, it's essentially a platform for governing, launching, managing financial assets. The way we like to think about Staker is it's really like equity in a company. Staker is a security. It's fully registered as such. And we came into this knowing that we wanted to be compliant with all legal and regulatory frameworks that exist. And so Staker is where all the profits essentially accrue, but there's also a large focus on governance. And so you can think of Staker as the overarching entity, while there will be a suite of products that exist. And so the first product that we are going to work with is called Blend, and it's going to track a basket of proof of stake tokens. And so I'm going to give a quick overview about how governance works for StakerDAO, and then I'm going to let Jonas take over on the Blend side because I think he's hopped on. And so on the Staker token side, again, it's a security. There are essentially two main functions that Staker token holders have. The first main function is essentially to vote on an annual basis for a Staker Council. This is more of a representative democracy model. We're kicking off here with 5 council members, and we've bootstrapped it for 2019, but we'll have another election in Q1 of 2020. And so that's the first major role that Staker token holders have to play, and they essentially vote or veto approve or veto proposals. The second essentially job that Staker token holders have to do is to work with the operations team that I lead to craft the proposals that we submit on chain. And so these proposals ultimately flow through the Staker Council and are implemented by the operations team if approved. And so Staker lives on the Tezos network. We've followed a similar governance process to them in the sense that we have a month-long process that runs 12 times a year, and there are 4 phases in each month. The first phase is really just about proposal submission. The second phase is about discussion and debate. The third week is voting by the Staker Council. And finally, we have implementation. And so that's all I really wanted to touch on the StakerDAO side, but I'm going to let Jonas here take over on the Blend side. And Jonas, I can walk through the slides if that's okay with you.
Sure, that's fine, Christian. Hey, everybody. Sorry I'm late to the call. Just got out of bed and realized I was running a little late here, but happy to talk you guys through what we're doing with Blend. So if you want to control this, are you saying you want to control the slides, Christian?
Yes.
Okay, sure, that sounds good. Okay, so as Christian mentioned, we have our first economic token that we're launching, which is called Blend. It is something that is anticipated to come to the market here in the May timeframe. We'll take you through kind of how it works and what the different mechanisms are for how it gets created, as well as more on kind of the governance or the regulatory side of this. You know, we're launching the Blend token following some securities and SEC frameworks. The first of which is that we're launching it from a non-US corporation. So our entity that we've created, Staker Services Limited, is a Cayman corporation. The entity itself is creating a subsidiary, which is a BVI corporation, Staker Services BVI. That is actually the company that's issuing the Blend token. And it's doing so under what they call in the United States, what's called a Reg S offering, which means it won't be for sale to US people. So you'll see that we're using CoinList as the offering, initial offering vehicle for this. The CoinList broker dealers are going to be selling it, but they will be selling it to folks who are not in the US. And part of our regulatory channel for this is to make sure that we don't sell it to people who are US persons. And US persons are people who either live in the United States or are US citizens. However, there's also this interesting caveat on it, which is you can in fact sell these types of tokens to people who are professional investors who qualify with a high level of investment capacity. I think it's like $5 million in assets under management. Anyway, it's ugly, right? I understand that, but it's also kind of one of the processes that we decided with this is that we're going to treat it in a way that we can manage it around US securities laws effectively and correctly. So that's kind of where we ended up with our regulatory framework. And Christian already talked about the council and the operations team. Christian leads our product team. We have other full-time folks who are working on bringing this product to market. Go ahead, Christian. Right, so quick overview of what this product is. The Blend token is an ERC20 token. It's what we call a tracker token. It tracks the value of an underlying basket of proof of stake tokens. We'll talk about some of those mechanisms here coming up. The initial offering through CoinList will have a $50 million amount of Blend tokens available. The mechanism of getting this started is a bit of a challenge because we're going from some kind of fiat or some kind of other token into this basket, and we need to, as the basket starts trading, the tokens in the basket start trading under our control, then we need to make sure that the price of the basket is reflected in the NAV of the Blend token. And so essentially what we're doing is through the CoinList offering, we'll be selling the first wave of Blend tokens to investors at $1 a piece. All that money that is raised during that first phase goes into a custodial account. And at some point in time within the first 90 days, that offering will fill up, or we will cut off that offering. And at that point in time, we will take those funds raised, and Christian's operations team will transfer those into the underlying basket tokens per the algorithm. And from that point going forward, we'll be publishing a NAV, if you will, of the Blend token. So what is the Blend token really worth based on all the holdings, all of the rewards, and all of the buyback and burn that we've done to it. After that point starts, once there's a NAV, a floating value for the Blend token, then the sale of the token will resume on CoinList, but it'll have a daily price that you can buy buy it at. So that's kind of the initial offering there. And then I mentioned the buyback and burn model. That is something we're going to cover here. It's our way of distributing the yield or the rewards, if you will, that come off these proof of stake tokens back to the token holders. And then two kind of interesting features for the token holders. One is they can participate in this tender offer, which is this buyback and burn. They can also participate in a quarterly redemption model. And so go ahead, Christian, you can take it from there. So Christian, maybe you can talk about how we came up with this algorithm for constructing the basket.
Yeah, absolutely. So for constructing the blend basket, it's something that we kind of looked at from a more, I guess, intelligent perspective. We looked at some of the indexes that exist today, and we realized that a lot of those solutions simply take the market cap of the top X number of tokens, and this ends up with tokens that are undesirable to some extent and cause a lot of controversy. I think for this particular implementation, we wanted really high quality assets, kind of like a blue chip index of POS tokens. And so really what we do in this construction is we look at the entire universe of proof of stake assets, everything that exists out there, and we essentially just screen them through a minimum market cap and a minimum liquidity. The liquidity is just so that we are able to trade these tokens without moving markets, and the market cap is a pseudo measure for, you know, blue chip exposure. And so once we screen all the proof of stake assets through this screener, then we essentially run a multi-factor model. And there are two components to this model. The first is really, what is the staking ratio of a particular token? And that's just, you know, the number of tokens staked on a network. And this is kind of a quality network for a quality factor for us. And so how much interest is there in this token? How excited are people about it? The flip side of this is really around the reward ratio, and that's kind of like a growth factor for us and kind of maximizing the profit or yield associated with a particular token. And once we rank these tokens through both these factors, we essentially just take the X number of tokens that exist from that list and construct a market cap weighted basket. And so the proposal for the initial blend basket will be constructed with Tezos, Cosmos, and Algorand. This is
cool.
Also expected to be rebalanced monthly and continuously seen and I guess updated by the operations team and council.
Yeah, so I think there are definitely opportunities here for the basket to change over time. I think we feel like the basket most likely will change over time. We're excited about it changing over time, either changing out some of the existing tokens that are in it, or more likely expanding the number of tokens that are in the basket. We think there's no doubt that tokens like Polkadot and ETH2 potentially are going to become part of that basket. We also think that the algorithm will probably be refined over time. One of the main points here to cover is, because as you guys get the understanding here, this is a centrally controlled product, right? In the sense that it's controlled by this DAO that is controlled by an operations team and the vote of the DAO members. And so because we have this fairly loose, it's not a rigid framework that once it's launched on the blockchain, it always and forever works that way. In this case, the governance is launched on the blockchain, and one of the key tenets of the governance model is that governance can change over time. And if governance can change over time, then any of the products can change over time as well through the governance process. And so, for example, if ETH2 were to come into the basket and it had a market cap that was, 5 times greater than anything else in the basket, we would have to change the algorithm so that our basket is not entirely made out of ETH2, if that's where the council wanted to go with this. Okay, so the reason why, so who's going to buy this token, right? Who's going to be interested in this token? All of us who are in crypto today, we're all the early adopters, right? we've all been looking at this stuff for months, years, a decade for some people, and we have all become fairly comfortable with the complexity associated with crypto as it is today. People on this call become very comfortable with the crypto as it exists today. We're all early adopters of staking. We all are spending a lot of time looking at new tokens and running nodes and dealing with private keys and picking validators and the risks associated with that and so forth and so on. Somebody needs to mute their phone because I can hear you walking around or whatever the case is. Thank you. And our thesis on this type of product is that we're all in on the notion that crypto is going to grow dramatically over the coming decade, and that the early majority is coming, and then the mainstream is coming. And there's a whole bunch of investors out there around the world, family offices, institutional funds, high net worth individuals who are curious. They're all crypto curious now. They've all been hearing about Bitcoin forever. They've all started to understand what Ethereum is. Maybe they hold some Bitcoin and Ethereum through some vehicle that they control. But now they're all wondering, what is this about proof of stake? What is this Tezos token, this Cosmos token? What is ETH2 that we hear about in Polkadot? How do we participate in that? And they run into a roadblock because they see how complex it is to actually do it effectively. And so those are the kinds of investors that we think we are going to find as the long-term holders for this type of basket token. Folks who are comfortable with holding an ERC20 token, but really just want to buy it, hold it, sell it, be exposed to the returns associated with it. Returns of the best proof of stake prices for the tokens that are in the basket, and also returns for exposure to the yield. And so our yield exposure, let me just touch on that, is around this notion of a buyback and burn. So, there's N million of dollars worth of blend tokens that have been purchased through the offering process. That means there's N millions of dollars of underlying basket tokens that we have purchased and are custodying and have delegated out to validators. And those tokens are generating yield. That yield is coming into the StakerDAO operations process. And what happens is there is a monthly tender offer where we take all of the yield that was received in the previous month. Let's call it $50,000 worth of yield was received across the 3 different tokens. We convert that all to USDC. And over the course of that month, everyone who is a blend token holder can register to sell back some of their blend to us. Do we have a slide on that, Christian? Is that what you're doing? Right. Everyone who's a blend token holder can register. This slide may be more complicated than what I was going to say, but everyone who's a blend token holder can register to sell some of their blend back to us in return for a price that they set. And they can place through our Ethereum contract. They're going to be able to place bids on how much blend they want to sell back at what price point. And then at a specified time and date, the contract will execute and it will buy back all of the blend that has been offered until it clears its monthly tender amount that it has in USDC, thereby essentially trading USDC for blend from the registered holders. The registered holders can price this as they are desired to. We expect that price point to probably be higher than what its NAV is at, but we think there's some mechanisms here that will be really interesting to observe over time, and that will clear out the monthly yield, if you will. At the same time, all the tokens that are purchased through this buyback process are then subsequently burned, and that will reduce the number of overall blend tokens in circulation, while the underlying number of tokens, POS tokens, remains constant. therefore mimicking, if you will, the receipt of the yield to all token holders, while not really actually getting new tokens. So, Christian, anything you want to add on that?
No, I think you covered most of everything there.
Okay, and are you, Christian, are you taking a look at the chat questions as they come in here, if there's anything that's relevant?
Yes.
I see someone asked about Algorand. They say Algorand has a market cap of 125 million, which I know you can touch on there.
Right, and so I think what we kind of address, rather than looking at CoinMarketCap or some of these other websites for what the market cap might be, we go straight to the network and we look at some block explorers like BlockWatch. We look at Algo Explorer, and we look at MintScan, and we essentially take the circulating supply from these websites and then multiply it by the appropriate price to derive the market cap. And we think this is a better measure and view of what the true market cap is, rather than what might be listed on CoinMarketCap.
Cool. Cool. All right. So you can roll forward there, one other slide, and just curious, we don't have a hard stop here today, so we can spend another 10 or 15 minutes talking about this. Okay.
Yeah.
Cool. So we've taken our basket and we've looked at, performance over the last year and a half now. Christian, you want to touch on what you've seen in your analysis here?
Yeah, I think just very quickly on this slide, it's really just about what the exposure might look like if someone would dive into Blend. So we think that most investors today that we target might initially only be interested in Bitcoin or Ethereum, but we think that they're going to slowly jump into the space around proof of stake. We think that actually might happen more quickly than others do here in the next 12 months. And so we think it's the right time to push a product like Blend forward. We think the performance in 2019 was incredible. This was obviously partly due to the run up in Tezos and Cosmos. Cosmos has obviously climbed back here in 2020, but the performance of Tezos in 2020 has also partly offset that. And so we see that it's interesting to have something like Blend in someone's portfolio. And so this is obviously back tested, a hypothetical performance, but we think it at least is helpful to start a conversation. Jonas, I think I see some questions in the chat related to, is Blend a security and how do we look at the regulatory issues around that? Do you want to touch on that?
Sure. Yeah, and so Brian asks, how do we deal with the regulatory issues around it, right? So Blend is being issued under a Reg S offering, which means it's not available to U.S. citizens, U.S. persons, as they describe it in a legal language. We are specifically only selling it to people who have gone through the CoinList KYC process and are qualified under this Reg S offering. Those people have specific rights associated with those tokens. So when you buy it from us through the CoinList offering, or in the future beyond that, you become a registered holder, which basically means that we have a cap table of such for the holders of the Blend token, and only registered holders are able to participate in the key elements of the Blend process, which are the buyback and burn around the tender offer that we just talked about. And also registered holders are also the only folks who are able to participate in the quarterly redemption process. So if you're holding Blend tokens, you can go through the buyback and burn, as I talked about. The other thing that you can do is you can also sell your Blend back to StakerDAO on a quarterly basis, and this lets you exit out to USDC, or ultimately to whatever you'd like at that point in time. If you acquire a Blend token through some other kind of exchange down the road, through Uniswap or something like that, you're going to need to register with us in order to take advantage of those processes, in order to take advantage of the tender process and the redemption process. And we believe that those processes are the central elements of Blend that will drive the value of the token over time, and that is only open to folks who are not U.S. citizens. So that's our process for managing the token from a regulatory compliance perspective. As I also mentioned earlier on, it is being issued by a non-U.S. entity, which is Cayman Corporation. And then I saw there was another question about governance happening on Tezos, and Blend token is on Ethereum. Absolutely, Christian covered that at the beginning. But an important element here again is that the Blend token is the first product being launched by StakerDAO, but it's not the only product that's going to be launched by StakerDAO. There's a growing list of potential products in our pipeline that are being generated by our community, and I suspect that those products will actually be deployed across a broad set of blockchains over time. One of the areas that is really interesting to us is getting a stable coin onto the Tezos network. There's a couple of teams that we're talking to about that. We'd really like to see that happen in the near term. And we very much would be interested in launching one ourselves if we're not able to collaborate with other teams on getting their stable coins on Tezos. Just as an example. So we think Tezos is the best place to run governance of this nature, but it doesn't limit us to only doing things forever on Tezos. Okay. So this whole token holder process slide that Christian has put up here basically just describes that path that I've taken you through. You can purchase it, you're going to hold it, yield's going to come in, and then you as a registered purchaser can participate in those two processes. At the end of the day, our goal is to slowly have a token that is accruing in value, but also shrinking in supply. And so we think that is a key mechanism for keeping the value of the token to track the underlying performance of the NAV of the underlying basket tokens that it holds. Okay, Christian. Cool. So just for so this deck that we're showing you here is part of the investor presentation that we're giving to these non-US investors around the world these days. And the coin list offering date has not been finalized yet, but we are getting close to finalizing the actual launch date on CoinList. I suspect it's going to be at the end of April or the beginning of May. And once that goes live on CoinList and their processes are in place, we'll begin enrolling people in the token. Minimum investment, you can see there. When we talk about how do we make money on this, so you know the notion here again is this is a for-profit DAO, if you will, right? The Staker token that Christian mentioned at the beginning is the governance token that runs on Tezos. It's on the Tezos mainnet today. It is a security, and we're treating it as a security. It's only available through us to U.S. citizens and others around the world who are accredited investors. We sold the initial offerings of the Staker token to accredited investors, institutions, venture capital firms. There's about 25 to 30 holders of the Staker token today. And at the end of the day, those people hold the Staker token because they want this company to profit from the products that it issues over time. And I don't think that's particularly different than people who hold a maker token, for example, who want to profit from the growth of DAI over time, for example. But but you know, the maker token is not necessarily treated as a security. We've learned from that and learned from what's going on in the market. And we said, yes, the staker token, we're going to call it a security. We're going to go full on for it, taking advantage of the emerging security token apparatus that is going to materialize, we think, over the next couple of years. Eventually, the security tokens will be much more liquid than they are today, but they'll always be, as far as we can tell, they'll always be treated as a security. And so they'll have to wait for security exchanges to materialize before they become significantly liquid. But in the meantime, there are a percentage of the yield, percentage of the rewards that are generated through the blend staking process. A percentage of those goes to become revenue for the staker token side. So if there's $10,000, let's call it, you know, if there's 10,000 TES coming in on a given day for rewards, 20% of that, so 2,000 of those TES, are going to go over to the staker side of the house to become revenue and ultimately profit. And 80%, 8,000 TES, go over to the blend side of the house to go through that tender offer that we discussed, the monthly tender offer. So essentially, we're charging a 20% fee on all rewards generated through the system on an ongoing basis to run it. And that is, you know, I'm sure the chats are going to light up here. Yes, that is an additional fee beyond what is already being charged by validators. And our perspective is, again, going back to who we think we're going to sell this token to. We're going to sell this token to people who want to participate in the market. They want to get involved, but they also want to trust a team to make those decisions for them. It's a managed product, if you will. And so the way we think about this is we're not a VC firm or a hedge fund per se, but we're also not just a staking operation, right? We're somewhere in between. So we don't charge, you know, if we were a hedge fund, we might charge on assets under management. We might charge on the gains, the carry, if you will, for that. In our case, we don't charge on either of those things. So we say 0% AUM, 0% on carry, but we do charge 20% on staking rewards. And we're going to see how that model goes. We think that it's going to be really appealing to people who are used to paying a higher percentage of their assets under management to have this kind of managed product available to them, but we'll have to see. And everything else here, I think, is pretty straightforward. So, Christian, I think I'll pause there and see what kind of questions we have. And if you think there are any other slides in the appendix that we should cover off on, we could do that as well.
Hi, Jonas, it's Brendan here. I'll just jump in with a question. Can you talk about your process for selecting validators for this?
Yeah, I'd be happy to, although Christian just published the proposal for validator selection on the through our governance process. It went live a couple of days ago, and the council will be voting on it this month. So Christian, why don't you talk about it, and I'm going to post a link here in the chat so people can go look at it themselves as well.
Got it. I can pull it up here on my shared screen as well. And so we've, as Jonas mentioned, we've kind of submitted the proposal for validator selection and how that process might look. Really, we have kind of 4, I guess, sections for our selection criteria. And the first, we have a series of questions here that essentially need to be answered with a strong yes. The first question is really around, is the validator a staking token holder or otherwise represented by one? The reason we're pushing forward with this initial question is really because we wanted to reward the early investors, the early validators that participated in the staker token fundraising round that we held by being able to delegate assets to them. And so we think down the line, we will include other validators, especially as Blend continues to accumulate AUM, but we think this is the process that we want to launch with. The other questions here in this process are really just questions to make sure that the validator is capable of handling our delegation related to how long it's been operating, where it operates, what its efficiency is, what the slashing risk might be. what its fees might be. We're careful here to kind of deviate away from exchanges to really contribute to the health of the network and the security of the network. After we move past Section A, we really have just one kind of qualitative question, and that's to make sure that the validator isn't viewed extremely negatively by the community. And so we don't think this is a very difficult question to pass. We just don't want a malevolent actor into the space. And so the meat of this is really around Section C, which is how much each validator will be delegated. We're allocating funds essentially across 3 variables. The first one is really just around number of delegates, just the respective amount of delegates one validator may have in relation to the sum of all validators, how much they have in assets under management, again, in terms of their respective share of AUM to the total sum of validators, and then what their fees might be. Really want to drive that down to around 10% on absolute terms. And so we have a quick example here of how that might look. Just kind of theorizing 2 validators, how many delegates each one has. We take considerations related to if a validator might be artificially inflating their delegate count. We will look into their delegates and make sure that, you know, there's not just one TES being delegated to this validator across multiple wallets so that they can increase their potential share. The last section is really just around fail-safes related to capacity. If a validator is unable to accept additional delegations related to Blend's underlying assets, if one validator is incapable of handling the additional delegation, then we distribute it to the other validators that have been pre-approved by us. And this lasts for 1 quarter until the other validator is capable of showing their ability to handle that additional delegation. So this is the main architecture for how we will select validators at this point in time. We will be launching with these initial validators for Blend when it goes live. Algorand, we will, you know, self-custody and self-validate because there's really no complexity around it. And then for Tezos and Cosmos, we've outlined a few names that have been helpful in this process, and again are represented either by a Staker token holder or our Staker token holder themselves. And so that is the gist of the validator parts of it. Please feel free to ask any questions, or Jonas, if you have anything else to add to that.
Yeah, I would say that, you know, the whole reason why StakerDAO exists and this product exists is because I spent, you know, the last couple of years running a validator in the Tezos ecosystem. Tezos Capital is my validator. It was at a point in time the largest validator in the Tezos ecosystem, and I discovered that, hey, I was actually really reliant on the success of Tezos. And I remember talking to Lorian over at Figment early on after Cosmos had launched, and Lorian Figment was in a similar position to us, except on Cosmos, they were really contingent on the success of Cosmos. And so we met in New York at one point in time and started talking about, you know, my pitch was, hey, let's figure out how we can swap some risk on these 2 chains. And that conversation never turned into anything official, but it started this conversation about what kind of synthetic products could be brought to market and how could you manage those in an effective and decentralized way, and how could you get the validator community involved in it. And so when we actually got around to putting this process in place, you know, Polychain led the seed round of this, and of course everybody knows Polychain has a huge stake in some of these tokens and in validation, and it's been, you know, a great thought leader on a lot of this validation stuff. We got Coinbase involved as well, and of course they have a huge stake in this as well. And so, but my underlying goal here was I really wanted to have a broad set of validators also involved in this process. And obviously there's lots and lots of validators that we could select to do the validation on these tokens and the growing set of tokens that are going to come. But I thought an interesting filter would be that those who actually hold Staker tokens should have a voice in it. But because Polychain holds a lot of Staker tokens by virtue of funding the seed round, we didn't want them to have a huge voice in moving all the validation to them or Coinbase or myself. And so all three of us are excluded from being selected. That's one of the caveats down there at the bottom. So Polychain, Coinbase, and Tezos Capital, we're all validators of the last resort, only if for some reason we're not able to find other validators through this process that fit the budget. The good news is for the funding round that we conducted, we had about 5 or 6 or 7 different validator teams that invested in the Staker token. Precisely what I wanted to have happen early on here so that we could have their voices and we could use them for validation services. My hope is that other validators will see this once we actually have the blend token in the market, once there's actually validator funds flowing through this, they'll be like, hey, I'd like to get a piece of that. They'll want to participate as well. And then who knows, the next product that we bring out might be an NFT basket, and that might bring a whole bunch of other people to want to be Staker token holders, for example. So that's kind of my secret way that I hope to grow interest in this over time on the Staker token side, besides just VCs who are in it to make a return. So let's see, anything else, any other questions we've got here? It's open now if anybody wants to ask a question.
Anyone there? I was just going to say, Jonas, I think you did an amazing job there. You've covered so much ground there in 25 minutes, so that was amazing. Sorry, somebody was about to come in there with a question.
Yeah, so actually, thank you, Jonas and Christian. So the early part of your presentation covered a lot on US securities laws and specifically how operations of the StakerDAO are structured vis-a-vis US securities laws. I'd like to get a sense of whether you've needed to structure your operations in a particular way to meet, for example, European securities laws or Swiss security laws, or like.
Right. So the initial pass through all this for us has been, SEC requirements, right? And making sure that we are not running afoul of the SEC offerings or excluding ourselves correctly. However, with the addition of CoinList running our offering from a broker-dealer perspective, that will also include a set of requirements for specific jurisdictions that they will manage themselves. And so as a broker-dealer, they're going to be responsible for qualifying people, for verifying that they can hold this token, and for those people to submit the appropriate documentation. So I expect different jurisdictions will have different levels of qualification participation, and whether or not they'll be allowed or what the requirements will be. And that will all be part of the onboarding process through CoinList.
And do I understand it correctly that if I have to obtain the blend token, when I participate for the first time in the CoinList process, at that point there's a regulatory barrier. I have to prove XYZ and then get the blend token. But once the blend token is obtained, I can transact with it freely on Uniswap with any other Ethereum address or whatever, and that token can go to a different Ethereum address, and there are no regulatory checks there.
Right. So you could move it to a different Ethereum address, and the main control that we have on this here, and the reason why we have a registered token holder list such as yourself, is because only registered token holders with registered addresses are allowed to participate in the tender offer, the monthly tender offer, or being able to sell those back. And so ultimately, all exits through the system have to come the same way that they went on, through the registered token holder. So if you're a registered token holder, we're tracking that, and we don't really know or are going to be looking in detail of what happens to those tokens once you've registered them. We just know that you can only take part in our smart contract by being on the registered token holder list.
So in that sense, it is similar to something like USDC. So at the point of issuance and redemption of USDC, there's a regulatory barrier, but on the blockchain, the token itself can flow to any account without unnecessary barriers.
So, yeah, obviously, yes, that's we all know that's how the ERC20 tokens work. And, you know, I think one of the interesting elements here for folks who are registered holders of this is they do become a gateway for funds to be able to move in and out of the system, right? So, you know, we suspect, you know, this is not a token where we sell it to early people and they then sell it on because they get the profit from it. There's no profit to be had with this token by flipping it, right? The token represents an underlying, you know, fully collateralized basket of tokens that generates yield that flows back to those token holders through the burn method. And so it's not like a traditional, you know, utility token in the sense where I can get in early and buy cheap, right? You get in when you get in, and your getting in would be just the same as if you were buying the underlying assets yourself. You just don't have the complexity of having to do that yourself. So I think it's entirely likely that people who hold blend tokens may very well want to use them as DeFi primitives, but we'll leave it up to the market to figure out how that happens. And at the end of the day, the underlying value that those blend token holders have, or those blend tokens hold, is fully, you know, based on the collateral that we're holding. And so we think it's quite different than, you know, tokens in the past that have had, you know, different reasons why people held them for speculation purposes.
And I'm also curious about, so it's called StakerDAO, yet this structure has to interface with legal requirements. So, I mean, what I'm curious about is the interface between the StakerDAO and the world of, you know, like corporations. Like, what is that interface like? So I'm assuming that the DAO itself is a set of smart contracts on Tezos. But since that DAO is issuing a security in the form of blend, presumably there has to be some kind of corporation associated with the DAO. And how does that interface work?
Yeah, exactly. And so, you know, obviously this is a brave new world here, and we're all thinking about these areas and how do you fit something like a DAO into the regulatory landscape. That's, you know, one of the main things that we're trying to do here. And so in our case, what we've done is we've created a corporation, a Cayman limited corporation, which is Staker Services Limited. That is the legal entity that sold the Staker tokens, and the Staker tokens. And so just to get into kind of the way this works, it's pretty interesting. There are two, there's Class A shares and Class B shares of this Staker Services Limited. And the Class A shares are the shares that control the board of Staker Services Limited. And the Staker Services Limited Class A shares are held by only one person, and that's me. And the board is only one person, and that's me. And I exist in this legal context of owning the Class A shares of Staker Services Limited purely to be that legal and regulatory nexus. So it's, you know, my my neck on the chopping block around all of this at the end of the day. Yeah, and I've taken all of the responsibility into those Class A shares, so that we also have Class B shares, which everyone holds who participates in the DAO. And so when you own a Staker token, you own the equivalent. The equivalent of that is owning a share of the Class B common of Staker Services Limited. The Class A common Staker Services Limited that I hold also map 1-to-1 over to the Staker tokens. So my founder's share of Staker tokens are the same value, if you will, 1-to-1, just like my employees and all of our investors. Everyone holds Staker tokens, but for everyone except me, those Staker tokens are represented by Class B shares, and mine are represented by Class A shares. And we've in our contracts, we've given as much power to the DAO as possible, while still having someone who can be responsible for signing the legal stuff that the Cayman entity needs to sign. And so the governing board of the DAO, which is elected by the Staker token holders, has broad authority to drive the strategy for StakerDAO. They just can't, you know, at the end of the day, if they do something that's illegal, the Class A holder, me, has, you know, the veto authority over it from a regulatory perspective. And it's not, again, obviously that's not decentralized. We all are nodding our heads. Yes, that's not decentralized. But it's the way that we figured out we could fit it into the regulatory framework that exists today. Now, I would love to not be in that responsibility. I would love not to be the guy who's holding those Class A shares and have to make those decisions. I would love for nobody to have to do that. And I think if we can get this thing running and growing over time, I suspect that eventually we will find ways to sunset that and to be able to make it fully DAO driven. Maybe it's all our products will be in the market and running by the time we do that. I think that's sort of where MakerDAO is going now, right? They've got their framework out there. You know, once they make MakerDAO fully decentralized and community governed, it'll be a lot harder for them to launch new products. But I don't think they necessarily are having a vision of launching new products. So that's how things are structured today. And we'd welcome other ideas. And I would love to see 100 experiments, you know, blossom here of different people finding different ways to tackle this.
So, so in a sense, it's like the Class A shares consolidate legal liability, but also get veto. And the Class B shares, the shareholders don't have legal liability, but they are subject to sort of overall. I mean, the DAO holders can do something, and then the Class A shares could override them. Now, is there some way to have multiple Class A shareholders? And of course, the legal requirement to become a Class A shareholder could be much more stringent. But if in this structure, if there were multiple Class A shareholders and multiple Class B shareholders, then that is a DAO, according to me. It's just.
Can I just suggest we make this the last question? I know people have been, we're kind of gone way over here. So yeah, if we can wrap it up there, maybe we can take it offline if we have more questions about the legal structures. But Jonas, do you want to quickly answer that then, and I'll wrap up?
Yeah, sure. And I would be happy, guys, to, you know, follow on, have one-on-ones on this stuff, or talk about it in our forums. That'd be great. We're really interested in ideas here as well, and helping other people see what we've done. I think the answer is you certainly could have multiple Class A shareholders in our model. We specifically decided not to have multiple Class A shareholders because we didn't want a tiered system like that. We wanted to have as little liability on anybody as possible related to the compliance side of things, while still being able to pass pass the liability test. So you would think that Polychain, as being the seed investor, would be the most likely ones to have, you know, authority in this from a Class A perspective. But no, we put everybody on the same playing field, including myself, from a staker token holder perspective, with the hope that, hey, all Jonas needs to do is sign some documents when they come through. But that's the best case scenario.
Cool. Well, that was great. Thanks a million, Jonas, and thanks, Christian. Christian just posted the link to the Telegram community for Staker community, so do join that. But yeah, no, that's a fascinating presentation. Thanks a lot, guys, and
Okay,
thanks everybody. I know we're sorry we're a little bit running over, but thanks for your patience. And yeah, we'll be back in a couple of weeks. We'll let you know what the presentations are in a couple of weeks. But thank you very much, everyone. Cheers.
Thank you.
Bye bye.
Thank you. Bye.
Thank you a lot. That was amazing.
Bye.